Hey there folks, this is Gabriel Shahin, Certified Financial Planner and President of Falcon Wealth Planning. Today I want to talk to you about a question we get often, and that is, does real estate make sense as an investment? And the answer is, it depends. It depends on the property. We have a 4% rule, especially if you're looking to put down money on the property. And that means you have to make cash on cash 4%. And there are 3 additional benefits of why it also makes sense to invest in real estate. Let's follow here. So this is showing if you have a $500,000 home that you're looking to do. With the 20% down, that's $100,000 as a down payment. So that's what you look at for a cash-on-cash return is $100,000. Now, you're going to finance $400,000 at a 5% loan. That is a $2,150 a month payment over 30 years. Okay? If your property tax comes out to about $5,000, that's $400 a month. Your insurance is, let's say, $600 a year, that's $50 a month. Your total cost is $2,600. If you bring in $3,000 a month, you net $400 a month, which is $4,800 a year. $4,800 a year is what you net after all expenses. Now, you only had to put $100,000 down. So if you net $400 a month, which is $4,800 a year, on $100,000, that means your cash-on-cash return is 4.8%. That's what you have to clear. You need at least 4% to make sense as this is an investment for you. If you clear that 4%, then having it as an investment as part of your portfolio, depending on your cash flow, your work situation, how much you have in other assets, and how much additional you're saving in other assets, it may make sense for you to do it. We typically recommend that you're maxing out all your 401ks between you and your spouse or retirement accounts and your Roth IRAs, because if that ever becomes vacant or destroyed, you can turn those off, which allows you to release yourself of the frustration and the financial burden of holding 2 mortgages. So we typically recommend to do that first. But in a case like this can make a lot of sense. And there are, like I said, 3 additional benefits. Number 1 is every time your tenant is making the mortgage payment for you, they're paying down your principal. On a $2,150 a month payment at 5%, you're paying down your principal. They are $800 a month. That's $9,600 a year. On $100,000 of equity that the tenants are paying down for you, that's a 9.6% additional return on your money on top of the 4.8. The only thing is you don't see or touch or feel that 9.6 because that's an equity creation and net worth increase. In addition to that, there is another benefit of write-offs. The interest, if your $800 is going towards principal, $1,450 is going towards interest, plus you still get to write off the property tax and insurance. That's over a almost $23,000 write-off for you. And then you get this great write-off, which is why real estate's great, which is why you should never buy it into a retirement account. A lot of these people are pitching you could buy real estate in your IRA. One of the biggest benefits of doing that is depreciation. That's one of the best benefits owning real estate. It's this fake write-off the government legally gives you. In a property like this at the 75% depreciation, you're looking at about $14,000 a year of depreciation over 27.5 years. That gets your total write-off of $36,000. Now, depending on your tax bracket, you could write off up to 50% of that. That could be $18,000 a year in tax benefits. Now, you do have to offset the income on that, and if you do that in a situation like that, you are still able to write off a good chunk of change. At the very least, the depreciation will make it tax-free, which could be a 7% write-off. That 7% is what you see in tax savings. That $7,000 a year is based on the $100,000 down you did for the property. Okay, so right now, if you add this up, you're at 5 plus 10 plus 7, you're at almost 22% return on your money, cash on cash, and that doesn't even include the growth of your real estate property, folks. There's one more benefit, even though you feel maybe interest rates are going high. In this example, it's 5%, and that is your mortgage payment stays flat. Rents increase over time. This is huge for you, where the worst cap rate you will get, theoretically, is year 1. And why? Because it appreciates over time, number 1. Number 2, you get write-offs will continue. Number 3, every time you pay down the principal goes down more and more and more as you pay it off. And lastly, as you increase rents, the cash flow goes goes higher. This is why real estate is great, because people are actually comfortable using a mortgage. Unlike an investment account where people are not comfortable borrowing to invest in stocks or anything like that. We call that margin. So it's funny how the mindset is, but if you have questions on this to see if your rental property you're looking to buy makes sense, and if it does work out, give us a call. We'll be happy to help.